Sarah Borgson-Keto, and in conjunction with REIT's REIT Week 2020 Virtual Investor Conference, I'm joined today by video link with Jim Connor, Chairman and CEO of Duke Realty Corporation. Jim, welcome.
It's great to be here. Thank you.
How does Duke's position today compare with where it was during the great financial crisis?
Well, the company is vastly different. I would hit on probably four highlights. First and foremost, the balance sheet. In 2008, at the start of the great financial crisis, we were about 52% levered. Today, we're 31% levered. Our portfolio back then was 57% office and 35% industrial. Today, we're 100% industrial. Geographic diversification, back in 2008, less than 2% of our NOI came from the high barrier tier one markets around the US, and today that's over 42%. And then lastly, land. We had just short of $1 billion of land, which can be obviously a large drag on the balance sheet in 2008. And today we've got about 325 million. So those are probably the highlights, but again, vastly different company than we were the last time.
Are you seeing much variation in operating conditions across your various markets?
Our sector is one that is actually performing pretty well relative to a lot of our peers around NAREIT. I will tell you, we're seeing a little bit slower decision making, and a lot of that is a result of people trying to figure out how to tour properties, final inspections, how to get proposals or final approvals through executive committees and boards and things like that. We're adapting just like NAREIT is adapting at this meeting. We're doing virtual meetings, we're doing virtual tours. We've been known to go and open up a building and let people tour it by themselves so they don't have to worry about any aspect of social distancing. I'll tell you, in terms of our own business, the tenant size, we're much more active on the larger deals, and I think that is probably just logical. Those are the companies that are performing a little bit better. They're more capitalized, and they're out trying to take advantage of opportunities where the smaller guys are just simply trying to survive. And there are some industries that are very, very active. E-commerce, which everybody would obviously conclude, but food and beverage, technology, pharma, and bio are all companies that are very active for obvious reasons. Travel, trade shows, specialty soft goods, in-store retail is obviously suffering greatly. So those businesses are hurting, and we're not seeing a lot of activity there. But, all in all, we're actually pretty pleased with where we are in terms of the deal velocity and our ability to lease space, do renewals, and do new development.
What is the outlook for development and capital deployment at this time?
When we issued revised guidance at the end of April with our first quarter, and we cut our capital commitment by about $550 million. So we've suspended speculative development. We're still doing build-to-suit development, and we think we'll do somewhere between 350 and 450 million of development versus we were over $1 billion last year. And we also cut back on acquisitions and dispositions, just simply because right now we're kind of on the sideline taking a wait-and-see attitude. The core assets are really continuing to trade at what we would call pre-COVID pricing, so there's been no disconnect there. There still is a bit of a disconnect on the bid-ask for either value-add or more traditional multi-tenant projects, and I think that's really just a fundamental. There aren't enough data points out there, and nobody wants to be the first, and nobody wants to make a big mistake. So people are kind of sitting back waiting. So I think those are reasonable numbers where we're seeing the business today. I think if occupancies continue to hold and rents and leasing activity continues to hold, I think we could accelerate some additional development, maybe bring some spec development back in the latter part of the year. Still look to do obviously some acquisitions. So we think there's an opportunity for us to be at the high end of that guidance or perhaps exceed it, as long as we see the economy and the pandemic continue to get better.
More broadly, how do you expect the pandemic to impact the demand for real estate across your sector?
There are a number of very secular changes that I think are going to benefit our sector and our company, not only today, but potentially for the next 3 to 5 years. Obviously, you've had accelerated conversion to e-commerce, and we haven't seen the final numbers, but e-commerce has been growing as a percentage of sales. There's been some estimates that this has accelerated e-commerce conversion by probably 3 years, and not just Amazon, but the Walmart.coms and the Target.coms and a variety of other users. There's still continues to be a need for last mile facilities. And again, not just Amazon, UPS, and FedEx, but a lot of our customers are finding the need to get goods to not only their stores potentially, but to their end customers much quicker. So, the days of the million square foot warehouse and distribution center that was covering an 8-state area that might get a delivery to somebody on a weekly basis has been moved in much closer to major metropolitan areas so that they can compete with the Amazons of the world and getting goods to their customers within 24 hours. The other one is it's kind of a new term that people are hearing today, and it's called safety stock. And, over the last 5 or 6 years, you've had a number of major disruptions to the supply chain. You go all the way back to the labor unrest at the ports of LA and Long Beach 5 or 6 years ago, and we can all have visions of large container ships just waiting out in the Pacific Ocean for the opportunity to come in. That put a big dent in a lot of people's supply chain waiting for that product. Fast forward to 2019, we had trade tensions with China, potential trade wars, tariffs, lots of things upsetting the supply chain and goods coming from China. Then you roll right into the pandemic. China was hit with the pandemic in November and December, even into January. They started to recover. The U.S. gets hit with the pandemic. So all of these interruptions to the supply chain, whatever it may be, are causing your major retails, major e-commerce companies to say, there's a certain amount of, it may be raw material, it may be parts for assembly, and it may be finished goods, but there's a certain amount of inventory that we're going to need to keep available in our warehouses in the U.S. so we don't suffer these major disruptions in supply chain. So, the shortages that we've all experienced at the grocery store or Costco or wherever you go, whether it's, cleaning products or, toilet paper, we've all been joking about, all of these things, our clients are saying, we're going to need to keep more inventory on hand so we don't suffer the fate from these different supply chain interruptions. And then the last driver I would tell you about is this continued interest in onshoring. And, that's been a big theme for the current administration to bring jobs back to the U.S., manufacturing jobs, assembly jobs, and more warehouse distribution. And I think that's only going to continue.
Jim, thanks so much for joining me.
Sarah, I'm glad to help, glad to participate, and good luck with the rest of NAREIT.
And for more news and information on REITs and listed real estate, be sure to visit NAREIT's website, REIT.com.